Netflix hitting an all-time high in yesterday's session. The company is hosting its annual shareholder meeting today. Joining us right now is Mark Mahaney. He is Evercore ISI's head of internet research. He recently raised his price target on Netflix to $1,350, which isn't that far off from where the stock sits right now, even though we're hitting these new highs. The last tick on this was $1,241, Mark. What makes you think the momentum continues here?
Well, it may not, Becky. Look, the stock's up 40%. It's trading in the upper end of its valuation range. This is a small buy for us, but it's still a buy. You've got, with its strongest near term, you've got its strongest content slate perhaps ever coming up in the back half of the year, when you've got the season finales of shows like Stranger Things and Squid Games, also the very popular show Wednesday. So the content slate is super strong in the back half of the year. You're starting to see, based on what happened at the upfronts a few weeks ago, advertisers start to pay more attention to Netflix. It's not a must buy, but it's a must consider based on the channel checks that we've done. This company has shown in the last couple of quarters material, 10 to 15, 20% upside to operating income estimates. So the operating income is rising. The free cash flow is rising. The fundamentals are one of the strongest in large cap internet today. It's probably a sustainable 25 to 30% earnings grower. So that by itself, is the leading play in streaming with a company that probably still has less than 10% share of its global market. That's a pretty powerful combination, and it's a good reason to stick with the stock, especially if you have any recessionary concerns. Particularly if you have some, this is one of the assets that consumers probably stick with more than any other.
Yeah, I mean, they were talking about how they're going to spend $18 billion in content, and that's not anywhere near hitting a ceiling. Is this just a simple flywheel at this point? You've got the eyeballs to keep them. You have to keep spending money on the content, and can anybody catch them?
Yeah, somebody could catch them, but we've had a real separation between Netflix and the other streaming companies. I'd say for the last 3 or 4 years, the market for streaming has been growing for some time. It sort of inflected up during COVID, and very few companies kind of stayed with the course and kept with the spending. Netflix did, and this is something where the bigger you are, you can bid on these sports rights, or you can bid on these major content franchises. Whoever has the most subs can amortize that content, the cost of that content over that subscriber base. So there are real advantages here to being the largest player in the space. There's also much less regulatory risk for a name like this than there is for the other big tech names like a Google or a Meta. So that sort of explains why Netflix is sitting where it is. But again, Becky, to your kind of implied point earlier, look, the valuation here is pretty high, and the stock's had a great performance. It's a small buy. I think there are much better buys in the internet space, but I'll stick with Netflix. It's a really well-proven management team, great business model, large total addressable market or large TAM. These are the kind of stocks you want to own in your portfolio. You want to dig in aggressively when there's a major correction. That's not where Netflix is now.
Two quick questions. Who do you think is in the best position to catch up or take a dominant second place position in all of this? And very quickly, you don't have to tell me why, but what are the better internet buys in your space?
Better internet buys, I'm going to work backwards, are Google, Amazon, and Uber. And then the biggest competitors, YouTube, Amazon, and Disney. All three of those companies are long-term competitive threats and risks to Netflix.